You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. He's speaking to us from Gulf Shores, Alabama. Welcome back to the show.
Jim, thanks for having me. I'm sorry for being late. I've got construction going on, so if I sound a little distracted, it's because I am.
Yeah.
When you get your house torn up with floor construction, you got a mess.
So you have an excuse to get hammered.
Exactly.
Tim,
kind of like the market.
Yeah, kind of like the market. I'm taking a look at the Dow today, down nearly 500 points. The NASDAQ, 300 points. It's been like this for the last few weeks. Can you see anything that might have triggered this?
Well, it's not hammered yet. This is just, I wouldn't consider this a hammering. I think the hammering is to come. But, you know, we've talked for a long time about the everything bubble, and I know it became, monotonous to even talk about it. But I've also talked about, I think I talked about it on the show a little bit, or on our, I say the show, on our broadcast. I've certainly discussed it in detail in the research letters recently since the election. Everybody looks back to the last administration, Trump administration, and say, oh, well, things were so great then in the fabricated extended bubble with the credit expansion that went on during that time frame, that everything was so great, making America great again, that this time would be a repeat. And I said no. In print, I think we talked about this, that we're at a different juncture, a different cyclical juncture this time around, and that we had this long-term economic cycle that's been trying to turn. And I think that's what we're seeing. I think we're seeing that start to set up. Of course, there's always some fundamental something that people point to and go, see, that's it. And I would think that probably people are looking at the tariffs and saying that's the catalyst. But whatever the catalyst may be, the longer term setup that we've been talking about appears to be trying to take hold. Now, there is a couple of important things that happened this week. Looking back at traditional Dow theory, which was the methods that Charles Dow wrote about in the Wall Street Journal, back in the early 1900s, we had a traditional Dow theory primary bearish trend change on Monday. And typically there's a pretty good bounce following one of those changes. So I do think there's a bounce out there coming, but this primary trend change should not be taken lightly. In spite of that bounce, I think there's always, by design, if you think about it, to trigger a primary bearish trend change, the market's always going down for that to happen. And when that happens, you're typically moving into a cyclical low. So by definition, you move into that low, the market bounces. And I remember back in, I believe it was September of '99, Richard Russell was the old school leading Dow theorist of the time, and he made the call for the top in 2000. He triggered a primary bearish trend change, and like I said, I think it was September 23rd of if I remember right. I could be wrong on that date, but anyway, it was 1999, and the industrials bottomed in short order, and then turned up and moved to a new high. And so he had to suffer through that call looking like an idiot for a little while. But then, that top did occur in conjunction with the dot-com bubble top. And so what I'm saying is that there's always, it seems like by the sheer design of Dow theory, if you will, or the way it works, is that there's a bounce that comes afterwards. And I'm not saying that we go to a new high here. What I'm saying is don't discredit the bounce, because there's always a discrediting bounce that comes. This is part of the process with that setup. So I think this is more meaningful than people realize. And, I think finally it's trying to come together.
Mm-hmm. So how should I handle my stock market portfolios?
Well, I can't give specific advice, but it's like an old timer once told me. He said, everybody thinks there's two positions in the market, either being in the market and being long or short. But he said there's a third position, and that's the sideline. And I think preservation of capital going into the environment that we're in is probably not a bad idea. And again, that's not specific advice. It's just my opinion, based on what I think I see with this longer term setup trying to take hold here.
Now, how are things like crude reacting to this?
What we're facing is a deflationary downturn, and I know that's hard for people to grasp when they go to the grocery store and they see the price of everything. I get it, but what they have to understand is that it is this deflationary. How is it that I think Christina Lagarde, the head of the IMF, she said, if inflation is the genie, then I think the ogre was the deflationary monster under the bridge or something like that. And so the point being is that it is this deflationary, backdrop that the Fed has been fighting for the last 20 years. And like I said, we tried to turn down out of that bubble top. The organic top of the market, in my opinion, was in 2000 with the dot-com bubble. They reinflated it, which is exactly what they did. If you just have to look at the evidence, they reinflated it with monetary policy, pushed it into the top in 2007, creating the worst financial crisis since the Great Depression. And then we turned down into obviously the 2009 low in conjunction with that crisis. And then what did they do? More of the same. They reinflated it, more debt. Everybody says they're printing money. They're not printing money. They're printing debt. Even that's a lie. It's debt. Look at the 36+ trillion now. Every time one of these little downturns have happened, you see the debt skyrocket. Each time it's incrementally the acceleration rate of the debt is greater than the previous instance. And so coming out of the 2020 low, we saw that again, and now that's run its course, and here we are setting up again. And it's that deflation, that overtone that they have been fighting. And so I say all that to say this: in that deflationary environment, it all goes down. All asset classes are trying to deflate. It's out of the everything bubble is trying to unwind. And that's what's happening, or beginning to happen. It's beginning to happen.
We'll have more with Tim Cyclesman Wood right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Tim Cyclesman Wood. Tim, what's going on with gold in this environment?
Well, I think gold is pushing into a top. We've had a good 9-year cycle advance, and so far so good. I mean, gold hasn't given way yet, but the general commodity complex has, and I think gold will ultimately. What I'm looking for is some specific cyclical structure there to tell me that top is in, and then once that top is in, I think gold will ultimately succumb to the same deflationary forces. So far, the reason why it's done so well is because they've been successful at reinflating. And that's the question. Before the break, I made the comment, I said that this was trying to set up and the deflationary turn was, I forget my words, but, trying to take hold here. The question is, can they hold it again? Can they create enough debt? I mean, I think they're deliberately trying to take some air out of the bubble at this point, just like they did with COVID. But then I think that the plan will be to try to reinflate. And the question is, can they reinflate? And if they do, then I think gold will continue to do well. If they can, then I think gold will continue to do well. But if they can't successfully reinflate and we see gold start to turn with everything else, then that'll tell us that those inflationary efforts are failing. And I don't know the answer. I don't think they know the answer to that. I'm just telling you the environment we're in, and the charts will guide me. But right now, yes, this deflationary setup is trying to take hold, and like I said, gold has not succumbed to that yet. Interest rates are starting to show it. Need to see a little more there, but it's all a process. It's all interrelated. But I think ultimately rates go lower, and as well as commodities and rates have been the bounce that we've seen in rates. They have been trending back in the other direction recently. I think that's going to continue, and then ultimately I'll look for the peak in gold. But I got to see the right structure there with the cycles to confirm that, and I haven't seen that just yet.
Would you say the indications are the U.S. is recession bound?
Oh, absolutely. We've been recession bound. I think we've been in a recession probably for over a year. I mean, some of the data mining that I've done is looking at the growth rate of the unemployment rate. And what I have found is that not only is that tied to when the growth rate crosses above the zero line, not only has that been tied to a recession, but it's also been tied to four-year cycle tops in the stock market. And they kind of go almost hand in hand, not every time, but it's I forget my own statistic. It's been a while since I looked at that data, but they're definitely, when the growth rate goes above the zero line, it's been associated. I think it's been associated, if I remember my statistic right, that has been associated with a recession going back as far back as that data goes. And as far as the four-year cycle, I don't think every time it's happened it's been associated with a four-year cycle, but a four-year cycle has always occurred with that growth rate going above the zero line. So I think we're seeing both, absolutely, and I think that's been being papered over, telling us how great the economy is. And it's just I dispute that. The underlying data is just, in my opinion, does not support that we've had a strong economy like they've been trying to say. I think we've been in a recession, personally.
Tim, anything else you wanted to add to today's show?
No, that's pretty much it. Don't take the Dow theory primary bearish trend change lightly. And anyone wants the details on this research and what I think we're facing or setting up to face. And I've been doing actually I think a pretty good job at road mapping us through this landmine to this point. It's been a very, very, very slow process, but I feel like I've guided us well to subscribers, and with the interest rate cuts and everything. And now here we are trying to set up. So the key in my mind is to continue to try to navigate this setup. And is it on track, or is something happening to derail it, or how are they successful at holding it, et cetera, et cetera. So I'll be covering that in, of course, the research letter. So I think in my world, that's what's key, is understanding if this thing's getting traction or not.
And you can get that newsletter at
cyclesman.com.
cyclesman.com. Tim, thank you so much.
Yes, sir. Thank you for having me.
My guest has been Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. He was speaking to us from Alabama. If you have any questions for Tim or for any of our guests, you can send them to info@housestreet.com. Our YouTube channel is Talk Digital Network. Find us on X @HouseStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.